So what's driving interest rates? I think that this is, kind of the big question. And for those of us that are really taking a long-term view on interest rates and trying to, help our clients make long-term decisions, a lot of what we've seen since the last Fed meeting, it's geopolitical risk, and there's a lot of fear in the market. There's a lot of uncertainty. So, of course, back on April 7th, the cruise missile strikes on Syria, this had a big effect on the market. I mean, this really drove 10-year rates quite a bit lower, and it's something that naturally, anytime you talk about possible scenarios and war and of course, more trouble in the Middle East, this is something that scares the markets. They rush into U.S. dollar treasuries, and it pushes long-term treasury rates lower. It's kind of a knee-jerk reaction. Then, of course, shortly thereafter, generally the thinking is, well, there weren't a lot of people out there that expected for Trump to intervene in Syria. So the fact that he did, it starts, saying, okay, well, maybe that's not going to have some huge impact. I don't think, anyone expects World War III to start, but now we turn our attention to North Korea, and this is something that starts really driving the market. You start to see the VIX move higher. You start to see just volatility in general expectations of fear, options premiums moving higher. And right now we're still waiting to find out what may or may not happen with North Korea. And then the list goes on. I think that there's quite a few things right now that are driving the markets, and again, it's what drives the headlines and what people are concerned about, and how does this affect interest rates, especially how does it affect interest rates in the long term. And with all these headlines, with a constant doom and gloom, it drives the U.S. dollar interest rate lower. And I think that what we come to the conclusion of is most of the recent headlines really have little to do with what's going to happen with long-term interest rates. So we can sit here and talk about, what's happening in Syria or North Korea. And, of course, I never want to minimize the potential impact that, another war could have or what this could mean in terms of people's lives, but in terms of interest rates, it's not something that we expect to have a huge impact. Again, just driving fear higher. So then when we talk about what really does matter, it all comes back to the Fed, and I think that's why you really start to see long-term interest rates move higher in the week leading up to a Fed meeting, because all of a sudden, it's back in the news cycle. It's back in people's minds. People are thinking, hey, interest rates are actually moving higher. The Fed is moving forward with this plan to re-normalize interest rates. And again, that's what we've seen over the past couple weeks. The Fed starts getting into the center of the news cycle, and it's a wake-up call. People start hedging long-term risk exposure. You start seeing the 10-year move higher, and that's exactly what we've seen the last 2 weeks. And, the other things that we look at right now, tax reform is a huge deal. And in addition to the geopolitical uncertainties in the Middle East and North Korea, one of the reasons that we saw the 10-year dip over the last month was the failed health care bill. And it's not because health care really has all that much to do with what's going to happen with interest rates, but it showed that there's not a lot of unity in the Republicans that control both the White House and both houses of Congress. So, there's not a lot of unity there. They couldn't get anything done on health care, and I know they were trying again today, and maybe they did, but it starts to paint a picture, well, okay, if you can't get health care passed, will you be able to do anything on tax reform? The market really cares about tax reform. This is something that's going to have a material impact both on interest rates, equities, currencies. This is a big deal. And, by failing to get health care reform passed early on when they tried, it just doesn't bode well for tax reform. And then, of course, just going back to the Fed, labor and inflation are extremely important. So we had a little bit of a slowdown in Q1 in terms of economic activity, but interestingly, the labor markets actually remained pretty tight. So we're seeing, pretty close to all-time lows in unemployment, and of course we can dig a little bit deeper and talk about underemployment and so on and so forth, but we really are starting to see wage growth, and that's what the Fed wants to see. So tight labor markets, are something that we're seeing, and generally something that means money is cheap and the Fed wants to tighten.